Hello and welcome to the UNFCCC COP28 official side event on bridging the gap in the ESG financing of critical technologies for the hard-to-abate sectors, organized by KAPSARC and IEEJ. Decarbonizing carbon-intensive sectors is vital for achieving carbon neutrality. This session will focus on the role of the ESG finance and necessary policy and business strategies for scaling up the deployment of critical technologies in the hard-to-abate sectors, particularly in developing countries. For the welcoming remarks, I'd like to invite to the stage Tatsuya Terazawa, the Chairman and CEO of IEEJ.
Well, thank you very much for the kind introduction. My name is Tatsuya Terazawa, the Chairman of IEEJ, the Institute for Energy Economics Japan. It is my great pleasure to co-host this important event together with KAPSARC with my great friend Fahad. And I would like to thank all the distinguished speakers and the audience for participating in this event. Let me start with why we are talking about hard-to-abate sectors. Well, apparently you are here, so you understand the importance of hard-to-abate sectors, but let me just rephrase why it is important. My institute, IEEJ, has been issuing the long-term global energy outlook for years. Our approach is the so-called forecast-based approach, which is different from the recent IEA approach, which is backcasting, starting from carbon neutrality in 2050 and moving backwards to find what has to happen. Our approach is what is likely to happen based on forecast approach, and we try to incorporate the maximum deployment of technology which we consider are reasonably possible. And based on our forecast, our conclusion as of now is that by 2050, the global CO2 emissions would be reduced by 56% compared with 2021, which is significant. But when you think about carbon neutrality, it is 44% short of the desired outcome. If we look closely into that 44% gap, the vast majority, actually 3/4 of the gap, are coming from the emerging and developing economies and the non-power sectors. And when we look closely into the non-power sectors, they are exactly the hard-to-abate sectors, mainly from the industrial sectors and the transportation sectors. So our pledge is to realize carbon neutrality, achieve carbon neutrality by 2050. In order to make that happen, we need to deal with the emerging and developing economies as well as these hard-to-abate sectors. And that is the reason why we are here discussing about hard-to-abate sectors, in particular about the emerging and developing economies. The next question is then, how can we decarbonize, especially the hard-to-abate sectors? It's not easy. There is a reason why they call it hard-to-abate. It is hard to electrify. So we have to do several means together, approach together. The first is energy efficiency. This may be not the sexiest approach, but it has its effect. Japan has been leading energy efficiency, and since the first oil crisis back in 1973, we have been able to achieve a 60% improvement in our energy efficiency. We find that there is so much room that can be achieved, especially in the industries in the emerging and developing economies. So that's energy efficiency. The second approach is fuel switching. We believe, since in many developing and emerging economies, coal is widely used. So the short-term approach would be making the fuel switch from coal to gas. That is a pragmatic approach. If we look forward to the medium term and long term, we have to look for the next generation of fuel, which we consider to be hydrogen or ammonia. Hydrogen will be very effective in generating high temperature heat for the industrial process. Electricity is not very good at doing that job. Hydrogen can also be used for the reduction process for the steel production. And when we look at the transportation, as you can easily imagine, it will be hard to get on planes with heavy batteries. And batteries can run out. That same thing applies to long-distance shipping crossing the Pacific or the Atlantic Ocean. Batteries are not good for those long-distance aviation or shipping. The same would be applicable to very heavy load land transportation for trucks or buses. So these are the area in which hydrogen and ammonia can play a role in decarbonizing the hard-to-abate sectors. But the third approach is that in spite of all our efforts, at the end of the day, there will be significant CO2 emission remaining. So we have to deal with the residual CO2. That's where the negative emissions technologies would have to play a role. We start with CCS, CCU, CCUS, but for the midterm and long term, we have to look for the next generation technologies for negative emissions. It will take time, it's not easy, but we have to start now to develop the next generation of negative emission technologies to deal with the decarbonization of the hard-to-abate sectors. Let me talk about the developing and emerging economies in particular. As I stressed, we need to tackle the emerging and developing economies' carbon dioxide emissions. In this regard, Prime Minister Kishida of Japan announced his vision to realize AZEC, the Asia Zero Emissions Community. This vision is a vision to support the energy transition for especially the Southeast Asian countries to realize carbon neutrality while supporting their economic growth, while enhancing their energy security, and we do it together with our friends in Southeast Asia and our friends in Australia. As a part of this AZEC concept, one pillar is energy efficiency, as I stressed. Japan will be sharing the technology, transferring the technologies with those Southeast Asian countries, and in this regard, financing will be very important. And in this regard, we stress the importance of transition finance. What I mean by transition finance is that improvement from 100 of CO2 emission to 50 CO2 emission. If it's good enough, we provide the financing as a pathway towards realizing carbon zero. It's not limited to financing from 100 to zero right away. We recognize for the transition, improvement deserves financing. That's the spirit of transition finance, and we think it is very important, especially to support energy efficiency measures in the emerging and developing economies. Hydrogen. It is important for the Southeast Asian countries, but we need to have the supply chain for hydrogen. Just as we succeeded in developing the supply chain for LNG, we have to do that for the hydrogen and ammonia. It took us 50 years to develop the LNG supply chain as we see today. But for carbon neutrality, we have to do it faster. So we have to work closely with our friends, especially in Southeast Asia countries, to develop the supply chain for LNG and, for hydrogen and ammonia. Finally, to realize negative emissions technologies in Southeast Asia, we have several approaches. One is the Asia CCUS network. This is a network to jointly develop the technology necessary for negative emissions. And we are also recognize the importance to develop these mechanisms across borders. And this would require a mechanism to reflect the CO2 reduction in the national report of inventories. So we need an international discussion on this regard. So let me conclude by stressing that we need to deal with the hard-to-abate sectors, and that would require energy efficiency, fuel switching, including hydrogen, and negative emission technologies, including CCS. And we cannot do it alone. We have to do it together. And I sincerely hope today's discussion will lead to the decarbonization of the very important hard-to-abate sectors, especially in the emerging and developing economies. Thank you very much for your attention.
Thank you very much for the insightful remarks. Next, I invite to the stage Fahad Al-Ajlan, the president of KAPSARC.
Thank you, Noura, and thank you, Teresa-san. It gives me great pleasure to partner with IEEJ in this event here at the UNFCCC at COP28 in Dubai. While the energy transition and achieving net zero is a big challenge, it's a relatively straightforward challenge. We understand the technology that is needed, and while it's costly and significant costs are needed, and significant effort and challenges paves the way to that destination, it's straightforward. For the hard-to-abate sector, it's a much more challenging problem. When we're talking about hard-to-abate sector, we're talking about today 30% of global emissions. How do we classify hard-to-abate sectors? There is heavy industry, cement, steel and chemicals, as well as the transportation, the difficult-to-abate transportation, including maritime shipping and aviation, as well as heavy truck shipping. While technology has played its role, it significantly needs to do more. Today, around 10% of global CO2 emissions comes from the heat associated with the heavy industry. And so for us today, electrification is not a viable technology to get there. There are three challenges as I see them to abating hard-to-abate sectors. The first one is technology. The famous Goldman Sachs graph shows that technology cost and abatement cost goes up to around $4,000 per ton of CO2s to abate for the hard-to-abate sector. And so we need to develop alternative technology, we need to develop them fast, and we need to make them cheaper. That's the first part. The second challenge is the past 5 decades have been characterized by globalization. We're seeing this consensus fade away today. We're seeing much more industrial policy being introduced in different parts of the world. And so that would require a significant change of world trade and global trade as we see it today. And part of it will be focused on emissions and abatement. The recently introduced carbon border adjustment mechanism by the EU is a recent example. And so it's not going to be only about the cost and economics, but also it's around, a discussion around policy driven by government industrial policy. The last challenge is the financing and the investment, which is today's topic. Investment in these hard-to-abate sectors usually lasts for decades, if not more. We've seen steel plants and chemical plants and refineries that stood out for more than 100 years now. And so these investment decisions that we make today will last with us for the next few decades at least. And so we need to do this significantly today, and we need to find technology and deploy them at scale fast. And that is the finance question that we're here to discuss. We need to make sure that finance is we're able to raise finance and deploy financing for those technologies to achieve them at scale globally and not within specific regions. With that, I hope that the panelists today will have an enjoyable time explaining their work to us. Thank you.
Thank you very much, Fahad and Tatsuya-san, for setting the scene for exploring the opportunities and challenges of financing the transition in the hard-to-abate sectors. Next, we will have presentations, and we will start with Fatih Yilmaz, who will talk about financing hard-to-abate sector transition, trends, issues, and ways forward.
Thank you very much all for joining us in this evening. I'm going to summarize some of the recent findings of our work at KAPSARC, which will hopefully give a lot of breadth for the further discussions, and will give you a decent background about the current stance of the finance and where we sit with respect to these critical technologies. So let me start with a big picture. This is what you're seeing is a total clean energy investment that we are seeing out there, including all sorts of clean technologies, from renewables to electrification, energy efficiency, as well as CCUS and hydrogen. So it's been a drastic increase, especially after the COVID era. However, if you break down the numbers a little bit, things start looking quite differently. So you're seeing two lines here. These are the CCUS and hydrogen investments over the last few years. And there's not a mistake on the slide. The one on the left, you see thousands of billions, which add up to trillions. On the right-hand side, you're seeing basically single digits. That's quite actually low, despite the increasing trend. So let me put these numbers with contrasting them to the global scenarios. And there are various scenarios out there. One of the most widely discussed scenario is basically the IEEJ scenarios. According to IEEJ scenarios, in terms of CCUS, we need roughly $200 billion every year in this decade. Similarly, for hydrogen, for clean hydrogen, we need around $160 billion investment every year in the current decade, and the ambition basically goes on in the next in the next 2 decades, so forth. And I try to put, that was quite difficult, what we have achieved in the first 2 years of the current decade. That's remarkably, devastatingly very low. As you can see, for CCUS, it's around $4.3 billion on average we invested in the last 2 years. For hydrogen, it's not even $1 billion on average. So we are not doing very well. You probably, colleagues in this field, they probably have heard a lot about the ambitions growing up more recently with respect to hard-to-abate sector transition. And you probably have heard a lot about the project announcements. So let's take a look at those project announcements. So if you look at the, one of the quite decent data sets out there for hydrogen and clean hydrogen and CCUS projects, this is the Bloomberg's database we are looking at. There's been quite a remarkable improvement on the project announcements in the last few years. After 2020, we've been seeing quite a big number of projects being released, and you are seeing the bars here are basically the size, the capacity of these projects, million tons. If you look at the countries which actually announced these projects, in terms of CCUS, you see a lot of projects coming from mostly developed countries, and there's a reason for that, and I'll talk about it later. But for now, I just wanted to recognize that. In terms of hydrogen, there has been, again, the investments have been mostly led by developed countries, but there has been some developing countries or emerging economies releasing sizable projects as well. So let's put these numbers into some sort of aggregate capacities in the future. Looking forward, if these projects become online and start really doing their job, this is kind of the picture we are going to see in the next couple decades. Let's put them into a perspective with respect and contrast them to the IEA scenarios again. By 2030, in terms of CCUS, if all currently announced CCUS projects become online, we're going to have a capacity of roughly 70 million ton capture capacity. Although the scenario basically is 1.7, you can see the difference is quite huge. In terms of hydrogen, the picture is not very different. By 2030, the expected, or the scenario simply says, is 150 million ton hydrogen production capacity, where we're going to be simply hanging around 50 million tons. There was a little bit of problem with the data in terms of the commissioning year. If you add all that as well, by 2050, we need roughly 500 million ton capacity, and even the total hydrogen projects does not even add up to half of that number. So there has been quite a bit of a problem in terms of project announcements and actually FIDs, getting to the investment, getting to the finance into these projects and making them work. If you look at the current status of these projects as of now, majority of them, vast majority of them are basically in the very early stages. These projects announced, in the last 3-4 years particularly, they haven't even got to the some kind of investment decision level yet. And currently the investment decision, the ones which got actually some finance or permit or moving forward step, they're really, really tiny. You can look at the advanced development shares, basically. So what's going on here? We have quite a bit of an ambition. Projects are announced, but they don't seem to move forward. So if you think about the issues around CCUS and clean hydrogen projects, and if you talk to financiers, and if you look at the current policies, you kind of see a picture which I'm going to talk about next. So there's basically not much external finance available here. So I put together a slide summarizing basically our interactions with researchers, our work, as well as interactions with the industry. So you tend to have like 3 types of problems here. The first problem is about the current ESG practices. They simply don't provide a very clear guidance or clear stand on the CCUS and hydrogen projects. Secondly, you definitely see in most ESG frameworks, there's a prioritization of electrification and main focus on basically on the renewables, which is not bad, but obviously to really carry forward, we need to have a more sort of holistic approach for that. I'll talk about that a little later again. So, and there's also the next three items there. They're basically the technical difficulties that we are seeing for the finance of these projects, such as the MRVs, measuring, reporting and verifying the quality of the low hydrogen. What do we call low carbon hydrogen? What do we call an acceptable storage quality? Same with the problems with the market development, as well as the necessary infrastructure, some of the concerns to financiers particularly. And the last one, but not least, is the increasing cost of capital due to the global inflationary pressure. It's great that the monetary policy is taken on to fight the inflation, but that doesn't really help with the capital cost. And these projects are heavily capital intensive. They're looking at some sort of maturity of 15, 20, 25 years, where basically, even a small movement in needle in the finance cost can turn up to billions of dollars. So a lot of these projects are basically financed through government incentives or government subsidies, public money, or a little bit of that. Neil probably will talk about it. Also get some funding from equity, but very little portion. Take the IRA in US, 45Q, 45V recently. Take the European practices. So here is a figure that I provide you, trying to summarize some of these subsidies. So a lot of developing countries, they don't have the fiscal space or fiscal capacity to provide any of these subsidies. And that's exactly one clear reason why you did not see a lot of developing countries releasing projects in the earlier slide. So this is definitely a problem, mainly because public resources cannot be a sustainable resource for this gigantic investment needs. We are looking at roughly in total 5 trillion to 10 trillion for CCUS and hydrogen in the next 30 years. And simply this cannot be done by public money. We need to get more creative about the financing approaches. So some thoughts for further thoughts and discussion. Hopefully we'll get into them in the panel. So basically, we need a more comprehensive vision when we think about the hard-to-abate sectors. These sectors are extremely critical in the global supply chains. If we get an unwise transition in these sectors, that can really create serious problems for our economic system, all the way from inflation to some sort of systemic financial events. So in terms of policies, me first type of policies will not actually solve the problem, but create further problems. Thinking about the recent CBAM, for instance, may actually help solving some of the local problems, but can create some sort of tariff wars that we never wanted to have. And that's why we created institutions like WTO, never getting into a competition. And lastly, private capital is a must in this game. We need to really think about how do we reshape the global ESG guidelines. ISSB has been a great step towards this. It has been there's a board working on basically providing the least requirements for ESG, global ESG guidelines, which will hopefully be the global norm, but that has to be flexible and understanding the necessities of these projects in the sector, as well as global banking and insurance sector will be particularly important. We'll probably get into this a little bit in the further in the panel. Simply, global banks, they have significant exposure to hard-to-abate sectors. Take the European banks, a recent study from ECB shows 40 to 50% of current bank assets are exposed to hard-to-abate sectors. So this is not only a finance issue, but also a financial stability issue. Thank you very much for your attention. Looking forward to our discussion.
Thank you very much, Fateh, for this excellent overview on the trends and issues and steps forward for financing the hard-to-abate sectors. Next, we have Toshiyuki Sakamoto, the Director of Climate Change and Energy Efficiency at the IEEJ, to talk about technologies and policies for the hard-to-abate sectors.
Thank you, Noura, for kind introduction. My name is Toshi Sakamoto from IEEJ. I will be explaining the technology and the policies for the hard-to-abate sectors to set the scene. I will be talking about three elements. The first is our analysis of IEEJ outlook, which was mentioned by Terazawa-san in the beginning, and technology and the policies, industrial sectors, as well as carbon dioxide removal, negative emission technologies, which are essential for hard-to-abate sector. Please allow me to focus industrial sector due to the limited time. Teraza-san in the beginning mentioned what is IEEJ outlook. So just let me add that we analyzed two scenarios. The first one is reference scenario. This is kind of business as usual. The second one is advanced technology scenario, where environment and energy technologies are assumed to be introduced to the maximum extent possible. This is a primary energy demand. In ATS, advanced technology scenario, the global demand will peak before 2030. But if you look at region by region on the right-hand side, the ASEAN, India, Middle East, and Africa, in those regions, energy demand will continue to grow, whereas China will be decreasing energy demand significantly over the next 3 decades. This is a CO2 emissions, and as explained, introduced by Teraza-san, in advanced technology scenario, emission will be reduced from the current level by 56%. And as you see here, remaining emissions are largely from non-power sector, and also those are largely coming from developing economies. This is the final energy demand sector by sector basis. For industry, the fossil fuel will remain due to the difficulties of substituting high temperature heat. This is especially the case for steel and cement, as I will explain in the next slide. And for transportation, in case of passenger cars, in 2050, on stock basis, 60% will be electrified. But when it comes to heavy-duty trucks and buses, heavy-duty vehicles, it will remain at 47% hard to abate. This is clear contrast with household sector, where electrification is rather easy. This is the technology for steel industry. Steel is produced from iron ore by removing oxygen using a carbon and creating a CO2 emissions. In this decade, they have to improve energy efficiency technologies first. And in 2030, a new manufacturing process may start to be deployed. This is to a new reduction method using a hydrogen, creating just H2O. But H2O will reduce the temperature of the furnace. That is a technological challenge. And in 2040, a 100% direct hydrogen reduction may start to be deployed. But there is one important condition that has to be met. The hydrogen needs to be very, very cheap. It has to be as cheap as 50 cents per hydrogen kilogram in order to keep the same level of cost competitiveness of steel product. And also, even if a direct hydrogen reduction is introduced, there will be some residual emissions. Therefore, CCUS technologies are essential. This is a cement reduction pathway. As was the case in steel industry, their carbon emission intensity will be reduced significantly only after 2040. Cement, the clinker, is the major ingredient of cement, that is CaO, calcium oxide. This is produced from CaCO3 carbonate by adding a high temperature heat, which is higher than 1400 degrees. And that creates carbon CO2 emissions. And in this decade, just like steel industry, they need to continue to improve energy efficiencies. And fuel switching to natural gas needs to be considered. Currently, the heat is provided by coal. And after 2030, they need to consider fuel switching to hydrogen or ammonia. But unlike steel industry, It is very difficult for cement industry to find an alternative production process. So CO2 will continue to be emitted. Therefore, CCUS technologies are really essential for this sector. So what policies needs to be considered for these hard-to-abate industry sectors? Low emission material like steel and cement, as I said, require innovation of manufacturing processes. This can only happen through massive R&D effort and capital investment. This will lead to a higher price. Nevertheless, the performance, cement is cement, steel is steel. The performance of those low emission materials are pretty much the same. So unless demand for low emission material is foreseen, investment will not happen. This is typical chicken and egg relations. So virtuous cycle between demand and supply needs to be created by policy intervention. The first is supply push. Investment support for first movers, research and development and deployment. Hopefully support for both CapEx and OpEx. And demand pull, a market needs to be created by policy. The initial demand could be produced through public procurement, then regulation may be kicking in. The financial disclosure, the policies to encourage disclosure is important because it will incentivize business operators to reduce Scope 3 emissions or carbon footprint. Let me turn to technology for carbon dioxide removal, negative emission technologies. As I said in the beginning, CDR is essential for hard-to-abate sectors, not only industry but also transport. It can be divided into two categories, technology-based solutions and nature-based solutions. And DAX and BEX, as you know, these are the technology-based solutions and relatively high technology maturity and large removal potential, easy measurement of removal, together with long CO2 fixation period. But as you see, we have a wide range of options for CDR. The policy options for CDR, sorry for this is a busy slide, but a busy slide means we have a wide variety of potential policies to facilitate CDR. Number one, CFD, Contract for Difference. This was, as you know, introduced by UK government for hydrogen. It could be used for CDR as well. The second and the third is the government procurement of CDR credit. Number four, tax credit, and number five, fiscal support for CapEx and demonstration. As you see, in the typical example is US IRA. Number six, research and development support. I think many countries and regions are doing this already. Japan is the case, EU, US are all supporting research and development. ETS, European Union is now considering to acknowledge CDR in EU ETS. And lastly, number eight, this is kind of mandate, allocation of obligatory purchase. The government may oblige higher emission sectors to purchase CDR credit. And in fact, the state of California, the United States, is now considering these particular policy options. This is my last slide to explain to what extent the governments are expecting with regard to CDR. As you see in the column of total, at the end of the day, at the timing where carbon neutrality is achieved, 10 to 20% of the current emissions will remain, and that has to be offset by CDR. So the government and the regions, European Union, their expectation for CDR is quite significant. Thank you for your attention.
Thank you very much, Toshiyuki-san, for providing this deep dive into the current trends and issues in financing and technology deployment. Next, we move into perspectives from three esteemed panelists. And the first one is a virtual presentation by Yumiko Hata, the Director of Carbon Management Division in the Ministry of Economy, Trade and Industry of Japan, who will provide the policy perspective.
Thank you. Thank you for your kind introduction. My name is Hata Yumiko from METI, Japan. So I would like to start the Japan's carbon management policy. So to start with the presentation, I would like to share Japan's move towards the carbon neutrality, green transformation. We call it GX. Japan's Diet passed GX Promotion Act this year and committed to provide massive support of 20 trillion yen over 10 years. Along with that, the government will introduce carbon pricing, which will be incentives for GX investment. We will also introduce ETS for high emission industry from fiscal 2026 and carbon levy for fossil fuel importers from 2028. Utilizing 2 trillion yen, $153 billion of GX bond resource, we will support various activities of green transformational businesses, such as hydrogen, ammonia, as well as CCS for hard-to-abate sectors and carbon recycling fuels and CCU to further invite private investment. Regarding CCS, METI published CCS long-term roadmap in March this year. To secure stable energy supply and green transition, we are aiming to start CCS business by 2030 with around carbon dioxide storage capacity of 6 to 12 million tons per annum. To realize that, METI started advanced CCS program projects, selecting 5 domestic CCS projects and 2 overseas ones, and supporting them. Furthermore, we are now undergoing the legal discussions to secure the right of business of CCS and set obligation to them for further business predictability. Hopefully, we'd like to submit CCS business bill to the Diet in the next year. We believe Japan is one of the countries which has various technologies for CO2 value chain for more value creation and extending our discussion to Asian-wide. And we established the Asia CCUS network, international industry, academia, government platform in 2021. It aims to share knowledge and develop a business environment for CCUS utilization throughout Asia. In addition to CCS, we also promote utilizing CO2 carbon dioxide as a resource to produce various products such as fuels, chemicals, and cements, and so on. METI published carbon recycling roadmap in June this year, identifying necessary technologies to promote R&Ds in this area. Japan's business enterprises are seeking suitable places in a worldwide to make some e-fuels or carbon recycling products, and we will also support those move in CCU and CCS for further GX. Thank you.
Thank you very much, Hata Yumiko, for this great presentation on Japan's activities and particularly diving into the carbon management technology roadmap of Japan. So next, we will hear from Neil Brown, the Managing Director of KRR Global Institute, to give us the business perspective.
Sure. Well, thank you. Thanks for the invitation, both from KAPSARC and IEEJ, both two real leaders, not just in their countries, but globally. And okay, sorry, apologies. I was just saying nice things about IEEJ and KAPSARC, which I won't repeat because I'll be embarrassed. but thanks for having me, and to the prior panelists, really excellent presentations. You sort of took all my talking points, Fatih, but maybe just to, many of you I know are not in the finance industry, so just one line on KKR. We're one of the leading global investors in alternative markets, so primarily private credit, private equity. So we manage about $550 billion around the world. And we have quite big businesses here in the Middle East and Japan and of course elsewhere. So I'm going to really kind of reflect that perspective of an investor who owns companies and owns companies at scale. And the reason I say that is that I think that it's helpful to take a step back at the need and really the opportunity. As an investor, this is a multi-trillion-dollar opportunity every year, right? An incremental investment that's required across the energy transition and wider climate sector. And unlike other economic transformations that have happened, like digitization, this transformation is extremely CapEx heavy, right? You need to build stuff to be able to create green electrons, green molecules, green bytes, green widgets. That means that the capital requirements, I think as Fatih rightly said, must involve the private sector. And I would congratulate our hosts here at in the UAE for emphasizing that as part of their presidency. But as we look at that need, and the COP has done the global stock take, the first one, you sort of see two big gaps. One is in emerging markets, basically capital availability to help countries avoid going down the path that my own country and other industrialized countries have gone. And then second is scaled decarbonization, which is primarily in the industrialized economies, and then the more advanced emerging economies, such as India and China, that have large industries. And so to do that second part, you must address the hard-to-abate sectors, right? But how do you do that, right? This has to be everything has to be at scale, right? So I don't want to overlook the need for R&D in early stage companies, as we heard, but to really get the world on track to the Paris Agreement, you need to be scaling today, right? You need to be doing that in a few ways. One is mass deployment of existing technologies. So technologies like batteries for grid storage that we know work. We know the commercial model is basically there, and now it's a pure scaling play. Second, you need to scale newer technologies. A number of the hard-to-abate technologies, technologies to solve the hard-to-abate sectors, technologies that have been de-risked. We know the science works, but now we need to really get them moving at commercial scale on a global basis. And then the third, and this is the trickiest part, is we have to transition existing assets. Call it what you want, brown to green, whatever it is, but this is tricky for finance. A lot of investors won't go into this for various reasons we can discuss, but it's necessary because it would be an absurd statement to think that we're going to just completely rebuild the capital stock of all of the hard-to-abate sectors, let alone a lot of the power generation around the world. So far, in the hard-to-abate sectors for financing, there have been two main sources. One is government in forms of subsidy, in forms of grants. This is earlier stage demonstration, R&D, et cetera. And then the second, when you're getting to scale, it's been corporate balance sheets. And that makes sense because they can take a lot more risk and they can see it as a strategic investment. But the problem is both of those pools of capital are constrained. This was the point that Fatih was making. You have to bring in the trillions of dollars sitting in companies like mine, and then as we de-risk those investments, then you pull in the even bigger sums of money that are sitting in pension funds, sovereign wealth funds, et cetera, that have a lower risk appetite. Private capital, such as we provide, I think is going to play a very critical role in this process because you're creating a new asset class. And why do I think that we have to really step up here? One is that private capital can be patient. This is new stuff. We have to develop projects. It takes time. If you're a public company, you don't necessarily have time because you have to hit your quarterly dividend disbursements. Your shareholders, they may say they want a green transition, but they really want their dividends. That's one. Two is that you have to build the projects. And I'm not talking physically build the projects. I'm talking you have to mesh together stakeholders on the technology side, on the offtake side, the purchasers, on the production side, on the capital side, both on the equity and the debt, and create these new models to be able to scale because they don't exist today. And then the third is the flexibility that private capital can bring to the table for these transition assets. There are a number of, there's a tremendous amount of ESG pressure on financial companies, on corporates, that can really limit their ability to take a brown asset, whether that's an existing steel facility or it's a power generation facility, and invest the necessary capital to transition it. That's a big problem. Private capital has much more flexibility because our LP base, our investor base, knows from the beginning what we're going to do and can hold us accountable. Let me end this intervention with one comment. So all of that, well, I hope it sounds good. Maybe it doesn't. But I hope it's interesting. The challenge is that if you look at the capital stack today, where there's capital accumulation for these kinds of investments, there's a big gap. There's a lot of capital available at the early stage. So venture, growth, relatively small investments. Very expensive capital, but they're taking on technology risk. At the other end of the spectrum, and this was a point made earlier, there's almost unlimited capital available for mature renewables, right? Totally de-risked, everybody knows how it works, everybody wants to own it, and a huge amount of preference then for those kinds of investments. But in the middle, for scaling these technologies for the hard-to-abate sectors, there's a real lack of capital accumulation. And that's when I said that we have to create a new asset class. That's what I'm talking about. We have to be able to deploy hundreds of millions, even over $1 billion in equity per company, per project, to be able to actually meet those needs for this CapEx-heavy energy transition.
Thank you very much, Neil, for this wonderful reality check, particularly on the bankability, scalability of these hard-to-abate technologies. Last but not least, we hear from Manish Kumar Shrivastava, the Senior Fellow at the Energy and Resources Institute, TERI, who will provide the perspective of the industry.
Thank you, Noura. This is a very fascinating discussion, and I'm sure a lot of information. But what I'm going to, well, a lot of what I wanted to say, I would have otherwise said, has already been said. So I would probably make just one point. And that I speak from the perspective of India primarily, but I'm sure this is true for majority of the developing countries. We have heard that the hard-to-abate sector is really hard to abate. There are technological challenges, and then there is a problem of financial flows. There is a kind of a gap in regulatory or institutional support mechanisms, and so on. But what I want to add another layer from a developing country perspective to the challenges, which I call the paradox of scale. Now, we need finance at significantly large scale. That in hard-to-abate sector, as Neil said, this is a very capex-heavy sector. Now, when it comes to financing at large scale in developing countries, it faces even more difficult challenges than what is faced in developed countries, primarily because there is a higher risk premium. There is a cost of fluctuation in exchange rates. That makes the project developers very vary in terms of the overall cost, capital cost, processing cost. Now, through negotiations and other processes, even if there is concessional finance available, which it is not certainly in hard-to-abate sector, and particularly the technologies that we are talking about, the sheer scale of initial capital investment required increases the total absolute cost of capital. And that is such an important aspect that many of us and literature generally overlooks, that it is not just the rate of interest or risk premium that you pay, but the sheer absolute cost of processing can be very prohibitive. Now, that's the general understanding, but what I want to highlight here is that if we look at the structure of these industries in developing countries, and particularly in India, you have large players which are comparable to producers in developed countries, in steel and cement particularly, but you also have a mind-boggling number of smaller producers. So you have the scale paradox at two levels, that you have these technologies, the cost, if the cost would come down, they would come down. That's what traditional economic theory tells us, that if the scale of deployment is high, then cost would come down, market would mature, and so on and so forth. But here, we also have to bring down the scale of deployment and the technologies that are suitable at a smaller scale. In the small scale sector, just to give you an idea, in the steel sector, the average size of a producer is 0.1 million ton per year. Now, how will you deploy carbon capture or even green hydrogen at that scale? That is going to be absolutely prohibitive for them. And remember, almost 50% of steel production comes from these players in India. These are not going to be your target buyers or agents who would be looking up to, like, okay, in 10, 15 years' time, the carbon capture or green hydrogen would become viable, because they are not going to be viable for them unless and until you develop new technological solutions for them, unless and until a huge amount of R&D budgets are put in for what we call the miniaturization of technologies. That is really not on the agenda at this point, because we looked at the operational number of projects. That's a very, very far away. Now, so that structural composition of sectors in developing countries, where you have very small scales to very large scale, poses this paradox of scale, that you have to think about technology as well as financial products, financial mechanisms in both directions. Those that work for large players and those that work for smaller players. That really complicates matters for the kind of policy support, policy environment, regulatory recommendations that we expect from national governments. it is going to be a really Herculean task for national governments to think about managing these many diversities in the sector. We had that experience with energy efficiency scheme for the 8 industry sector in India, and then we learned that industrial sector in general is hard to abate sector in India. It's not the ones that come to mind, transport industry, transport, steel, cement, textile, but even other sectors are hard to abate from the policy perspective. Reason being that the technological diversity and the diversity of scale at which they operate, even target setting becomes very difficult. You have to engage with such a large number of stakeholders to come up with a policy which is equitable, which is pragmatic, which does not distort the market. And mind you, the markets in developing countries are already reasonably fragmented. So the context is very, very challenging. This is the layer that I wanted to introduce over and above, or maybe below what we have heard so far, and probably we'll discuss more later on. Yeah, just one more thing on finance. There is one company in India, I think it's Dalmia Cement, with ADB's support, they have prepared, they are willing to invest in a CCU project, right? But there is nobody willing to finance it. So even if there is willingness by a large player in developing countries, the international financial markets is not ready to invest, even at the scale, even when the balance sheets are super, So that's the perception of risk is something will need to be dealt with before we even think about any significant deployment of technologies like CCU or CCS. Hydrogen may be a different story, but I'll keep that for the next round if there is a possibility.
Thank you very much, Manish, for this very insightful intervention, highlighting the industrial challenges as well as the risk aversion of the hard-to-abate sectors, particularly in the Global South. So I'd like to kickstart the discussion, and we'll have a round of questions, and I'd like to get to the audience to take some questions from the floor. Fateh, if I may start with you. You highlighted the private sector, the role of the private sector in investing in the hard-to-abate sectors. So how can private sector investment reduce costs and promote the widespread adoption of these hard-to-abate technologies, particularly regarding when it becomes the primary source of financing and accelerating implementation?
Thank you, Noura, for the question. That's, I guess, not a million, but $1 billion question. From my experience so far, both on the written literature and talking to industry people, this is kind of the picture that I see. So when you talk to corporates, either financial or non-financial, everybody talks about offtake agreements, state guarantees, subsidies. We're happy to invest, we're happy to finance, unless we see these guarantees or supports from the state. And governments are in this very tough situation where they have promises, NDCs, they have to move the country forward to live up to the promises. But at the same time, they don't want to destroy their economy, obviously. They want to do it a reasonable transition. So answer to your question is not actually one side. Firms alone is not only firms to really do the job. It's basically some sort of a mix across these three players. Financial firms, non-financial firms, basically corporates, as well as the government policy. Some mix, some blending of all these, I guess, can solve the problem, de-risk. So in order finance costs to go down, what do we need? We need definitely de-risking the projects. We need a business model, as well as we need some sort of stability into the place. So how is this going to happen? From the firm's perspective, I'm talking about non-financial firms. They definitely have to have a very clear sustainability transition strategy where they have, if they are using CCUS in that, they have to be extremely clear about it, technical details. I was, some time ago, I was involved in some indirect talks between a major rating company and an entity where simply the major rating entity was specifically asking about the technical details. How are you going to do the impact? So if firms or non-financial firms can be very clear about their strategy with these technologies and be transparent about it, I think they can get some work done. Is that enough? Of course not. They have to be definitely innovative. They have to bring that private sector dynamism into the game. They have to definitely not only think about R&D, they also have to, as Neil earlier pointed out, they have to be thinking about the business models, basically productization. On the financial side, I'm very sorry, Neil, if you want to object to it, you're more than welcome. They want to play this extremely safe. I do understand they have responsibilities to their stakeholders, whatnot, but they are missing, I think, a very big part of the picture. There is already a huge asset size belonging to hard-to-abate sectors sitting on the assets or balance sheets of these financial institutions. You know, maybe right now there is not a direct regulation forcing them to do something about it, but ECB, for instance, European Central Bank, have been talking about it, putting some cap on hard-to-abate sector exposure. If certain regulation hits the financial sector, they're going to have to do something about it. So when you talk to them, the plan is pretty straightforward. We're going to go by offsets. Or right now, if you look at the carbon markets, financial players are the biggest buyers, thinking that they're going to utilize all that to decarbonize their portfolio. But maybe CCUS, maybe supporting CCUS projects can be an alternative strategy to decarbonize their portfolio, right? You have an exposure to this huge steel company. Why not to help him out to deploy the CCUS, decarbonize the company, and decarbonize your portfolio as well at the same time? Everybody is happy. Last point, governments. Governments definitely have to be there. There has been, throughout the economic history, we have so many market failures where government policy stepped in to fix things out. There is a market failure here, and government policy can definitely do something about it. We have policies like credit guarantees, has been used several times during the COVID, before the COVID, could be part of the game. So where is the solution? Is basically a blending of all these at the same time.
Thank you very much, Fateh. So we heard about de-risking, business models, and government policies and regulations. Toshiyuki-san, if I can bring you in the discussion here, at the heart of investments and investment decisions is the technology readiness, technology maturity. So in the realm of technology readiness levels, how do various sectors contribute to technology advancement across its stages: research, development, demonstration, and deployment, as well as adoption?
Thank you for that question. In my presentation, I introduced two different sets of technology. The one is technology for steel and cement. The other is technology for CDR. The first case, steel technology, the cement technology, obviously they need to develop these technologies by themselves. But the government support is essential. As Hata-san mentioned in her remarks, Japanese government is preparing a 20 trillion Japanese yen support for the next 10 years as part of GX initiative. 20 trillion Japanese yen is 140 billion US dollars. This is a bit smaller than US IRA, which is $369 billion. But if you compare the GDP, US and Japan, in the GDP-wise, our 20 trillion Japanese yen support is even bigger than US IRA. So I do believe that a significant amount of government support will be used for technology development, steel industry, and the cement industry. And then it will cover initial deployment because it would cover next 10 years. If they successfully develop technologies, that will lead to their enhanced industrial competitiveness. Now, in fact, in allocating 20 trillion Japanese yen, there are two important conditions the Japanese government imposed. That is, first, emission reduction, obviously. The second is expected industrial competitiveness increase, enhancement. So if steel industry successfully develop low carbon technologies in steel industry, then that would be competitive in the global market, in particular EU, where CBAM is introduced. And then that will create virtuous cycle leading to more production, leading to more deployment of new technologies. And secondly, the technology for CDR. As I said, the technology maturity level for technology-based solutions, DACs and BECs, are rather high. I just would like to mention as an example, first mover coalition. As you may know, this initiative was established by US government initiative as well as World Economic Forum in the margin of COP26. The idea is to facilitate the low carbon product, steel, cement, etc., through public sector's purchasing power. And CDR is part of that. Many companies under FMC, First Mover Coalition, committed to CDR to contract CDR credit by 50,000 tons by 2030, or a contract $20 million CDR purchase by 2030. And in fact, one of the Japanese major maritime shipping company committed to this CDR commitment under FMC. Maritime industry is one of the hard-to-abate sectors, so they are now expecting the CDR credit would be necessary in the future. Therefore, they have joined the commitment under FMC of CDR.
Thank you very much, Toshiyuki-san, on this great insights from the technologies and policies of the industrial sectors, but also the CDR technologies. Hata-san, if you can hear us, and if I can bring you into the discussion. Can you hear us, Hata-san?
Yes, I can hear you.
Okay, perfect. So if we can highlight the CCS technology roadmap of Japan, and if you can tell us what policies and regulations are required to accelerate the deployment of CCS.
Thank you for your great question. And we published CCS long-term roadmap in this March. And in that roadmap, we have identified specific actions, 3 specific actions. The first one is government support for CCS business. So to realize the sound economies for CCS businesses, we think it takes time because, as I said, Japan's GX law and carbon pricing is just starting from 2026. So if we aim to start a CCS business from 2030, we need to make CCS economics to support the CCS business as well as the emitters and related businesses. And in that terms, we will benchmarking the various countries' CCS supportive measures and legislations, and we will discuss and create the supportive measures before the 2026, when the many companies to make FIDs to start the 2030 the CCS business. And second action is effort to reduce the CCS cost. So to reduce the cost of CCS, we will further make the projects of CCS as well as promote the R&D measures and projects, such as carbon captures and transportation by ship, which is crucial for our CCS business. And third action is gaining the public understanding for CCS. And I think it's the most important point for Japan. And in Japan, in that public understanding, we have very good practice previous CCS projects in Hokkaido, the northern land of Japan. So at the Hokkaido, there is a small CCS demonstration site named Tomakomai, and CO2, carbon dioxide injection, was accomplished with a volume of 0.3 million tons. And in that CCS site, it is very close to the dense people's living areas, the city center. And in a very first stage, people are very much anxiety for the CCS injection into the deep under the ground. But gradually making the transparency for the data acquired by the CCS operation, people gradually understand what CCS is and how to ensure the safety of the CCS operation. At that time, big earthquake was hit to the Hokkaido land during the CCS operation is undergoing. But right after that, the scientists examined the relationship of the big earthquake and CCS operation. So, and their analysis showed there is no relationship between the big earthquake. I mean, the big earthquake didn't induce any damage to the CCS site, nor CCS operation didn't induce the big earthquake in Hokkaido. In that kind of activities, slowly we got the understanding from the citizens of Hokkaido. But at this point of time, we are aiming to have more CCS projects in Japan, and not only in Hokkaido, but also in the various areas in Japan. So I think the people's understanding is crucial to further promote the CCS business in Japan. And lastly, as I said, we are now examining the possible legal frameworks to CCS, and which is also crucial for CCS business to give the business predictability in terms of rights and obligation in the long-term operation of the CCS. Thank you.
Thank you very much, Hata-san, for providing this overview and summary of the CCS technology roadmap of Japan, highlighting the main takeaways, including government policies and regulation, carbon pricing, and public perception. And Neil, if I can turn to you, Hata-san mentioned carbon pricing. Is that a prerequisite for investment? What role do you see for private finance to accelerate deployment in that area?
Am I close enough? Okay, good. Okay, so carbon pricing. Actually, if I could actually just want to respond.
But also the role of the private sector.
Sure,
yeah.
sure. I just want to actually respond to Fatih's comments, which I thought were really good. But there were two things that you said that I think maybe are worth responding to. One is that you made a comment that finance wants very safe investments. I love safe investments, but I think it's more accurate to say that we're looking for the right risk return, so we have challenges in, are we? This was a point Manish made, which is, are we pricing the risk correctly? Which I think is a very legitimate question. But the key to I think really unlocking private capital, and this is to your point, or to your question, is you have to identify the categories of risk. You need to figure out, one, who is best positioned to take that risk. So if it's a technological risk, we as a financial player are not well positioned to take it. If it's a FX risk, that's tough, right? Because you need to rely on hedging markets to take that, and there are a lot of countries around the world that you can't do it. You can do it in Japan. You can sort of do it in India. It's pretty expensive, but there are lots of countries like Brazil, for example. Yes, you can hedge the real, but it's extraordinarily expensive. That basically makes it prohibitive to do these kinds of investments. So one, you got to allocate the risk, and then within that allocation, you then have to mitigate it and see if you can get to an attractive price. So that's one. You also said that for the financial institutions, and you're really talking about banks mostly, that they already have a lot of hard-to-abate assets on their balance sheets, and they need to be encouraged to invest in them to clean them up, right? And that could come in various forms. It could come from like an SEC, in the U.S. case, an SEC regulation or other bank regulation. Though I don't disagree with you, but I want to give one caution, which is that those regulations tend to push towards divestment rather than reinvestment to clean it up. And that is not a solution, right? It is not a solution if, name the bank decides, you know what, I'm just going to sell off this, if it's the power sector, this coal asset, or this cement company, rather than engage with the company to get it to clean up. Now, I know you weren't advocating for that, but we have to really be careful when we talk about policy of some of the unintended consequences.
Thank you, Neil, for highlighting these challenges and particularly bringing in the discussion around risk aversion. And I believe it's related to the maturity of the technology. And if I can bring you to the discussion, Manish, and give you an opportunity to delve deeper into the unique challenges that you talked about in India for overcoming the limitations of advancing the technology levels of CCUS and hydrogen in particular.
Thank you. I think the question of technology should always be seen as a system and combination of technologies. So to talk about one specific technology, in my view, is not always right approach. Similarly, what is, we say that to put combine all the risks perhaps is not a good approach for the risk and return assessments. We need to break down risks. We also need to break down hard-to-abate sectors into different technological opportunities that exist. Now, if we look at the landscape of technologies, say in both the steel and cement sectors, there are certain technologies that are at the TRL 9 level. There are, of course, technologies that are at level 2, 3, 4, 5. There are very few that are in between 6, 7, 8. Now, the experience is that even the technologies that are at TRL 9 level, their penetration is very low. So one has to think about first why the penetration of commercially mature technologies is low, because unless and until that happens, that actually is an indication of the how imperfect information diffusion is, how there are gaps in the market ecosystem for technological transformation or say greening of a sector type of goal. There are issues of transaction costs which do not encourage many of the players to take up projects. One experience I would share with you, we have been trying to set up a expert group of industry and financial institutions together to figure out whether they understand each other's issues in India's industry sector. And in one meeting, the industry representative kept on saying that, well, there are these type of risks nobody is willing to take up. There were financial players in the same room. They kept saying, no, we want to take that risk, but he was so convinced by the previous experiences that it is not. So even that conversation is very difficult in developing countries, because your engagement have been with select players on a project by project basis. So you are not aware how the ecosystem itself has been evolving over the years. So I think, as I had said, that the technologies are not ready for developing country market in hard-to-abate sectors, but the financial market is not ready, and the industry is also not ready. And a good part of that is because of prevailing imperfections in terms of information access in the market. So I think that's the biggest challenge to begin with. But strategically, my approach would be that first let's focus on the TRL 9-8 technologies, so that the balance sheet of these players also improves significantly, and that would perhaps make the financiers more willing to invest in these companies.
Thank you very much, Manish, for highlighting the unique challenges of the developing countries in managing technology maturity, but also presenting some opportunities, like bringing them to the same table, the industry representative, the government representative, and trying to manage advancing the deployment and maturity of the technology. So we have 10 minutes left, and I'd like to open the floor for questions. When we have one in the back, please.
Hi, thank you for a very interesting discussion. I found the slides of one of the speakers very striking, which showed the projected level of investments in CCUS and hydrogen versus the actuals. And I just wonder that, there's a lot of discussion around investors and their familiarity with particular sectors, particularly decarbonization of hard-to-abate sectors. But typically, investors are receiving a wide variety of inputs and a lot of information. They're probably some of the most well-informed people for their sectors. So I wonder if the investor reluctance to invest in things like CCUS and hydrogen is sort of foreseeing the lack of feasibility of these technologies themselves. Does it tell us something about the fact that these technologies have heavy limitations and won't work beyond a point? I'm just looking for some candid opinions on this, because as far as I understand it, investors usually know what they're doing and operate with a lot of information. So if they're not investing in particular sectors, should we have some takeaways from that? So just would like to hear the opinion of the panel.
Thank you for this important question. I turn to you, Fateh, and maybe Neil, if you want to add something.
Sure. I think that was my slide. And the big bars were coming from IEA projections or scenarios, and the tiny bars were coming from the Bloomberg database on energy transition investment, which is a quite decent investment data source tracking the investment flows. So I suppose they are correct. Maybe I and Neil has different opinions on this. I'm coming from a central bank background. That usually central bankers don't have good relations with the industry because they tend to be the regulators. So with that note, I don't particularly think that investors always have good approach, because obviously their objective is to maximize dividends and not necessarily whatever is best for the society. And if they don't see the means and resources and the risk return, quote unquote, acceptable risk return levels, they simply don't invest. Where the objectives of governments or more like the energy transition is actually maximizing the impact. That's the whole point of ESG, not maximizing only the risk-adjusted return. So they're quite low, definitely, because most investor perspective today is really following the kind of the old or traditional approach, risk-return maximization, where the new approach, with ESG and all that sustainable finance, is moving towards impact, creating impact, basically. Hopefully, if we can get investors' mentality moving towards the sustainable finance approach, then we can probably see a little increase in the numbers. Thank you.
Thanks, Fateh. Neil, would you like to weigh in?
Sure. Well, I would like to thank the questioner for the vote of confidence. I hate to burst your bubble a little bit that nobody has perfect information. We hope we have good information and make good decisions. But no one is perfect, not even finance. Let me just say one thing, which is I don't think that the point of ESG is social impact. I think that the point of ESG is to focus on materiality that is along the environmental social governance lines or just sustainability more generally, and to make better investment decisions. And our experience has been that there actually isn't a trade-off between being a responsible investor in sustainability and returns. In fact, if you do sustainability right, companies perform better. Right? This is different than probably some of the stuff you're thinking about, some of the analysis of ESG, ETFs, and other mutual funds that have underperformed. This is a difference, I think, between those public market indices and private investors, where if you control a company or you're a very large shareholder, then you can dictate outcomes. You can at least dictate the decisions made to try to reach those outcomes. But on this, the question, I wouldn't take the fact that there's lack of investment as a condemnation of the underlying technologies at all. I think that it can be related to a lot of things. It can be lack of imagination, it can be lack of interest in certain countries, et cetera, et cetera. But I think particularly within the CCUS and hydrogen space, there are a few kind of real substantive issues that have to be dealt with. Well, one is technology. I mean, there is still a range of technologies within both of those spaces, but let's focus on the technologies that are really scientifically de-risked. We know they work. So let's just take that as table stakes. One is a lot of these projects don't have a commercial case. They're just not a good business yet, and they're not a good business because they're not getting paid for doing the actual process that the technologies aim to do. So if it's CCUS, you're not paid for capturing, utilizing, or sequestering the carbon. And so there's we've heard some of the policies here on that and to overcome it, but you have to make it a going concern. That's one. And two is infrastructure, right? You have to be able to transport your CO2 or your hydrogen. That takes a lot of permitting. Three, you have to have a whole ecosystem. Single projects don't tend to work. You want a whole ecosystem, including labor. And so there are a number of other issues, but point being, you have to look at the whole range of issues when you're making the investment decision.
Thank you very much, Neil. And as the event draws to a close, I'd like to thank the organizers, the speakers, and the participants for an enriching discussion. It is evident that the path to decarbonizing the hard-to-abate sectors is fraught with challenges, but it is also ripe with opportunities. Thank you all very much.